Welcome to the daily update, where I'll go over the action in the market for Thursday, August 22nd, and then we'll see how things look for Friday, August 23rd. Saw a pullback, saw some profit taking, saw some selling into strength. Things did shift back more negative, at least in the daily session. It's still looking pretty good when we look at the short, intermediate, and long term, and it pretty much just looks like a decline. Now, we'll have to see if this develops into something more. And the big news on Friday is going to be Chair Powell's speech at Jackson Hole. And if there's any market reaction to that, or if it ends up being really nothing all that much, that's the variable that we're dealing with right now to see what happens. But in the short, intermediate, and long term, we still remain positive. Our list in the short and intermediate term of indicators that are extreme positive, that's getting quite a bit shorter now. So at least for the time being, things are not switching over negative. We'll just have to see if anything builds from here. Okay, I do have a thing called the SPXInvesting Program. It's currently free. I post additional videos there that I don't put on YouTube or Rumble. There's a link below this video that will take you to the website and some additional videos that talk about the program. I have delayed the weekly videos that I do. They'll now be available Sunday evening, US time, depending on where you're located within the US. And that's to give people that are members of the program who access the videos from the website, they get first crack at those videos. Not only the daily videos each day, but they'll also get about a day or so of access to the weekly videos before they go public. Also, this daily video is just one of many that I put out each week. All of them feed into the daily video. So let's go back and talk about what happened, and then we'll look at some charts. We did have a higher open. Futures were positive. Looked like, okay, we're just going to continue where Wednesday left off. We got up to R1 at 56.39. And unfortunately, right at the open, and that's about where we opened, that was the high for the day. We spent the rest of the day going down from that point, and then we declined below the unchanged level and the daily pivot at 56.15. Then I was really watching the 5,600 level as well. We continued to decline below that level, and we got down to S1, which was at about 5,600, about 3 points below at 55.97. That's where, when we broke below that and then got down to S2 and started to go below S1, that's when I pulled the trigger on some bullish positions that I had been riding. I had a couple that actually hit their profit target right at the open, and others that were closed with profits. Others were more with break even that were just set up in Tuesday's session, or was it Wednesday's session? Then we did try to bounce from this level, but that failed. And we saw prices go all the way down to S2 at this point at 55.74. And then we just kind of chopped sideways and we closed slightly below S2. We were down 0.89%. We're still below average with volume. But if you look at it over the last couple of days, it was above where it had been as far as average, but still taken all together as below average. So we're positive in the short, intermediate, and long term, but pulling back. We'll just have to see if it develops into something more. And yes, it's about inflation and interest rates, but it's going to be all about what Jerome Powell says on Friday and how that feeds into the inflation outlook and what interest rates may do. And then the geopolitical things going on, the war between Russia, Ukraine, potential escalation at any time in the Middle East, and what's that going to do if it has any impact at all on the markets. So some comments. This decline appears to be a pullback to this point. Now we just have to evaluate this and see if things kick into gear. There are some things that are looking a little bit negative, and I'll go through that as we go through the charts on a seasonal basis, and some pressures that are always on the market. But we'll have to see. If buyers outnumber sellers, then we go up. If sellers outnumber buyers, then we go down. And in Thursday's session, the mega caps and the semiconductors, that's what really dragged things down, especially at the index level. The NASDAQ and NASDAQ 100 closed at their 50-day simple moving averages. We want to keep an eye on those. Now, we follow the S&P 500, but especially the NASDAQ 100 and the S&P 500 are pretty closely connected since they're stocks in both of those indexes. And the FANG index, the Facebook, Apple, Amazon, Netflix, Google, NVIDIA, so forth, it actually closed below its 50-day moving average. So this is one of those warning signs we want to pay attention to. And then this mass index, one of the indicators that I follow, it's actually signaled that something's supposed to happen. Now, I'll explain this again when I get to that chart, but the idea is whatever was happening that led up to this signal being triggered, this indicator suggests a reversal will end up happening. The track record for this indicator is so-so, but we want to know about it and pay attention to it and at least respect it, because sometimes it's been a pretty good signal. Here's our list, and it's quite a bit shorter than Thursday's video, where we still have the slope oscillator looking extreme positive, the Stochk RSI, Williams percent R, and the stochastics. Now, all of these being extreme also suggest good momentum, but it can also indicate an overbought condition in due of a pullback that we see and what we saw in Thursday's session. On the intermediate term level, also, the list is quite a bit shorter with one new addition to the list, our longer-term 10-day moving average of the S&P 500 highs minus the lows. That's more momentum taken over a 2-week period of time since it's based on 10 days. But we still have the TTM squeeze, the CMB composite, and the bullish percent index for the NASDAQ 100. And we're still looking rather extreme with the 200 period simple moving average. The 150 has now dropped off the list. And there's really no change to the scenario. Well, I'm waiting to see what Chair Powell says to see if any changes to this will end up happening. But the market is pretty much said by the Fed and priced into the market that there's going to be some kind of a rate cut in September. The dollar was up and interest rates are also up. We're still well below 4%, but we were up with the 10-year yield to 3.86%, where we had been at 3.78%. And the dollar being up because it's really been under a lot of pressure lately. So we kind of just saw a reversal taking place on Thursday. We're still inverted with the yield curves. Sentiment ticked down. We had been at 51, which is neutral, but a slight positive slant because we're above 50. The sentiment score is based on a 0 to 100 scale. Or we came down to 48, but that's still neutral. We're positive with our trend. The green line is still on top. The ADX continues to weaken. It's below its moving average, but we're still in a trending environment because we're above 20. The bias is negative with the down day, but I'm still keeping the momentum at positive since the last number of days have been positive. Okay, we did get a lot of reports on Thursday, only a few charts though. The real focus were the initial jobless claims came in at 232,000. That's more, which you kind of have to retranslate that, means weaker than expected, because more people filed for claims than what they thought at 225,000. Last time it was at 228,000. So this is a little bit of a concern to the market as we're watching these reports come out. The continuing claims also ticked up, and I'll have charts of both of these to show you, at 1.863 million. Last time it was at 1.859 million. Okay, these I don't have charts for. The takeaway from this, when we look at the global manufacturing PMI, we're below 50. That shows contraction. Last time we were at 49.6. This time we came in at 48. Also, whether it's above or below 50 is the real takeaway here. When we look at services, it came in at 55.2. Last time it was at 55. So we're seeing a contraction in manufacturing, expansion when it comes to services. Existing home sales came in a little bit stronger than expected at 3.95 million. They expected 3.9 million, which is what we saw last time. Here are the charts of the weekly jobless claims where we are ticking back up, but when you look at the 4-week moving average, it continues to decline. And then the continuing claims also continue to go up. here as well. And the moving average is also slowly going higher right now. So we look at that in the context here of the red line are the initial claims, the blue are the continuing claims, and then the last time we had the unemployment rate, it was at 4.3%. All right, Isabel Net blog charts. This just takes a look at the Fed funds rate against the annual change in the S&P 500. It goes all the way back into the 60s. And just, I don't know really what use you can get from this, because there are times when interest rates going up can put a real strain on stocks. But there's other times when interest rates go up and stocks can go up at the same time. It's the context, it's the environment that we're in at any given time that determines whether interest rates going up or down are positive or negative. There's other times when they cut interest rates and stocks still go down. So, okay. Yeah, and this is another technical analysis chart just shown a little bit different way than what I've been seeing. And of course, since we've been going up, this all looks rosy to the upside. If we have another down day or two, or if it looks like we're starting to reverse, then they'll post charts that show targets, going down and arrows going down and all that stuff. But this is a daily chart here, just showing the different levels and different potential overhead resistance. And if we continue to fall, some possible support areas that we may see. I don't put this many lines on here. Yeah, we look at previous highs and lows, and we will often match up especially while the market is open, but to follow every one of these, because they may not actually come into play. Usually I follow the moving averages. We have Fibonacci retracements and extensions that we look at, and we do look at more swing highs and lows more than just, okay, this was a high, so this must be a dashed line. For me personally, this chart's a little too busy, but you may find it useful, which is why I decided to include it. Cumulative flows since the start of 2007. So this is just showing, and I go through this in the course, the basic course that is available on YouTube and Rumble, but that's a few years old. The updated version is available on the website. When the market is doing well, like it's been doing in 2023 and so far in 2024, that's when passive funds start to do best. Those are generally just stick it into an S&P 500 index fund or a NASDAQ 100 fund, or there's really nothing to manage. That's why they call it a passive fund. It's just whatever stocks are in the index are also in that mutual fund or in that ETF. When the market starts to run into problems, active funds, this is where you have a manager who actually oversees things and shifts things around. Like ARK is a managed ETF. And so that tends to hold up better, and not ARK, but managed or actively managed funds or ETFs tend to hold up better when the market's more under pressure, because they have more room to maneuver. They can shift, where when you're in an index fund, you're just, okay, if the index is going down, your ETF or mutual fund's going down at the same time. And this just shows a lot of money going into passive funds and coming out of active funds, because a lot of folks know that this general principle is true. And then this is just the net between the two here. Okay, median S&P 500 stock short interest. There's a couple of different ways to look at this. There's also some other things to take into account. When the short interest is pretty low, 1.8%, that means, okay, you can take it right at face value saying there's not a lot of short interest, meaning that these are folks that think the market's going to go down. Now, at the same time, if the market ends up going up, this can potentially turn into buyers, because they have to sell to get in to short the market, and they have to buy to get out. And that's what we call a short cover rally or a short squeeze, when all of a sudden it just keeps going up and up and up and up and up, and it seems like it's out of control. Well, a lot of times that's short covering taking place. Then another thing to consider here, though, is that this is quite risky, and the financial requirements to actually short either stocks or an index are a lot more stringent and a lot higher than what a lot of individual investors usually have available to them. Well, what an alternative can be is we have access to inverse either mutual funds or ETFs, where you can go long in an ETF, but it goes up in value if the market goes down. And the same is true with a mutual fund. And so there aren't the big financial requirements associated with that. So I do pay attention to short interest. I don't pay as much of attention to it now as I used to, say 15, 20 years ago, because of this alternative. And in the program, what I teach, we take advantage of this all the time. We have those types of ETFs that benefit when the market goes up, and then we jump over into other ETFs when the market goes down. And we also implement calls and puts, which are another alternative as well, where there aren't the huge financial requirements that are needed. Okay, equities as a percent of total household allocation coming in at around 57%. Back in the late 60s, a lot of folks were getting into stocks. Of course, it seemed like everybody was in stocks during the dot-com boom and then bust. And it's getting back kind of high again after the whole great financial crisis happened and wiped out a lot of people's investments at that point. Then looking at the mega cap growth and tech positioning, it had become kind of extreme here, getting above this 1% standard deviation level. Now we're starting to drop back down. Now, if this continues to fall down, that would be more negative. If we can turn and go back up, as the market had been bouncing until Thursday, this probably would go back up as well. And then I did find a few interesting charts here. This was put out by Lance Roberts, who's associated with Real Investment Advice. And it says the S&P 500 above its 200-day moving average for more than 200 days. All right. Then he says, okay, to be exact, it was 201 days. Sounds like a lot. Well, past 3 times when we were over the 200-day moving average for 200 days, it stayed above for another 277 days, 242 days, and 195 days. So that, according to this, still has more room to run to the upside. Now, you can see, okay, this only goes back to 2010. We'll have to see, what about back in the 60s, 70s, 80s, 90s? What happened there? I haven't really researched this myself. It's just he went through this research here and just said, okay, in other words, if you're bearish because this rally is long, be careful because it can last longer. And of course, the perma bears, no matter what you throw at them, they'll twist it all around and say the market's going to tank for even if the evidence suggests otherwise. But in the longer term, in the bigger picture, things could still go on for a while. Just because it has gone on for a while doesn't mean it has to stop. Then another one, currency used for global payments. Now, and I plan on doing a supplemental video, which will be available to members at some point down the road. Is there really a death to the US dollar? There's one side that says yes, there's another side that says no. I usually treat it as both sides and just say, okay, here's the proof for one side, here's the proof for the other side. Now you make the final decision. But when you use this SWIFT system for global payments, the US dollar is still way at the top of the list. And so in this type of chart, looking at the evidence here, the dollar's doing just fine when you compare it to the euro, others, the British pound, the Japanese yen, and is that the Swiss franc? Anyway, CNY at the bottom there. And then the number of stocks outperforming the index, yeah, the greatest since yesterday. I don't like these greatest sense type things or lowest sense or worst sense. It's like, what was the context at that time? But this is actually healthy for the S&P. It just shows that most of the stocks inside of the S&P are actually set to outperform the S&P 500. And as of the time this chart was made, we were at 296, which is higher than what we've seen recently. And this is just suggesting that there's more broad participation across the S&P 500. Another area that we've been watching, and I will probably do a supplemental video on this for members at some point, is what's this whole thing going on with commercial real estate? Is it going to fall apart? There's both sides to this, and that's what I usually address in these types of videos. But this is the value of seized commercial real estate properties, and it's going up. Now, there's the other side of this that says, well, it's a good old boys club, and they'll just buy and sell to each other, and they'll work through it just fine, and there won't be any damage to them, the owners. But, what about the people? What about the tenants? What about the employees that need to work at these places? That could have an impact on them. If they're moving from one commercial real estate site to another one, well, are your employees going to move with you, or what's going to happen with all that? But this is just showing that overall the value of the properties that have been seized have been going up. Okay, let's go talk about what happened on Thursday. We did go up all the way to R1, not really a huge gap. You could call that a gap higher open, but we topped out right at R1, right at the open. And that's where we set the high. And then we just came down to the unchanged level. Didn't really find any support here. And just like yesterday, it looked like, okay, we're going to come down to the daily pivot. Well, we actually dropped a little bit below on Wednesday. Well, now this is when I really started to pick up and say, okay, maybe today's going to be a little bit different here. We just really came down. There was an increase in volume. If you look down here at the bottom with this particular bar, we were breaking below this daily pivot. We came down to about the 5,600 level, which was about S1. And then it looked like maybe this was a fake out because we dropped below 5,600. And that could be to take out some stops. It's called gunning for stops. There's probably a whole lot of stop loss orders right under 5,600. Well, we came down just enough to wipe those out to get them triggered. And then, okay, maybe the market's going to turn around and go up. But that just didn't last. We got back above S1, and then we started going down again. We actually broke below S2, got back above S2, chopped along S2, and closed just a little bit below S2. There, how many times can I use S2 in one sentence? And we're up a little bit. We're up about a 1/4% to 1/3%. At least at the time I record this, it's still many hours before the market opens. And this has been a concern to us, but not a huge red flag, but still a concern where we still see the red line above the blue line. Now, both declined, especially the growth, that's blue, but we want to see the blue line above the red line, even though they are on different scales. And this is just a 10-minute intraday chart. And we had been showing a real improvement with S&P growth of value on the intraday chart. Well, that dropped off now. Is this the beginning of something, or are we just pulling back like we were before? Because these lines don't go straight up or straight down. We'll just see if this is going to actually develop into something. Because we were down pretty heavy. When you look at large cap growth, it was down 1.37%, where large cap value was virtually unchanged, just down slightly. Growth was down more with the mid caps and also more with the small caps. So growth, which had been doing better, not fantastic, but enough to keep the indexes going up, there was probably some profit taking in there. And that's where I'm coming out right now as what is happening, not necessarily an overall shift in the market climate until the evidence is there to suggest that. Right now, it just looks like, okay, we've had a pretty good run over the last few weeks since we had that big down day on August 5th. There's probably some folks like I did. I took some profits, so not really feeding into this per se, but anyway. So we came back down with the small cap growth to value ratio after it had been trying to bounce up a bit here. Mid cap growth to value also declined, and S&P growth to value also declined on our end of day charts. And we came back down here with the growth versus value ETF. We're still inside of this rainbow for the time being. And we ticked down just a little bit, but discretionary to staples, discretionary actually held up a little better, but we want to see it doing better than it has been. This is a big part of one of the sectors of the S&P 500, and it really helps the index go higher when discretionary is performing well. Large cap growth did decline 1.45%, but still above its 50-day moving average. And we did see a little bit of a tick up, even though everything kind of went down on Thursday. So there really wasn't much of a change here. When this is going up, that means large caps are outperforming. When this is going down, that means small caps are outperforming. And then we are looking at a positive trend. The green line's on top, even though it's rolling over, and the red line is coming up. The concern that we're seeing here is the ADX continues to weaken below its moving average. That suggests a weakening trend when we look at this on a more dynamic basis in comparison to the moving average. But on a static basis, when we just look at the level of 20, which I found over the years is a good level for the S&P, this still suggests that we are in a trending environment. And we're also seeing a weakening here with the ADX in the short term, green line coming down, red line going up. And we're still dropping off with volume, even though it was a little bit more on Thursday than what we had been seeing. And sentiment, we really dropped off here with the Ulster Index. It finally woke up and said, things have been going up lately. I think I'm going to be less fearful now. And we did go up with the VIX, still getting pretty low readings. We're around the 17 level here. And we also went above this moving average here with the bar chart, or on the bar chart with the moving averages. And when the VIX goes up, so does the VIX of the VIX. And that's what happened with the bar chart and the line chart. The momentum is still down, but if this continues to go back up, we're going to see the MACD start to turn back up as well. And we really shot up with the equity put call ratio. There could be some hedging going on ahead of what's going to happen on Friday with the speech. It's sometimes, like I said, it really has an impact on the markets, and other times it's a big nothing burger. And so folks with that amount of uncertainty probably want to get some puts to hedge their positions. And we're starting to bounce back up after getting extreme with our 5-day chart. Now, this, if it keeps going up, that would be more negative for stocks. You can see when we got to a really low reading and then started going back up, that quite often will put a lot of pressure on the market. And the 10-day, though, is still going down. This is slower, of course, so it takes a little while for this one to shift over. And this is what we're following on a seasonal basis. Maybe we've been coming down here in August now as the market's been going up. Are we going to reverse and really see the VIX start to go higher? That would mean stocks are going down. And we're also keeping an eye on this, the spread between risky and not as risky bonds here. This chart doesn't look all that bad here. What we're watching is the middle area of this chart. It ticked down a little bit, and it's still not really showing any massive fear, but it's not showing the lack of fear that it had been showing not very long ago. And we did get the latest reading of American Association of Individual Investors, not quite up to this pink line here, above 30. That's when they start to get extreme, a little too exuberant. But they did show an improvement in the 50-day moving average of how they're feeling about things. And I say they because that's us. We're individual investors. This continues to go up as well and is showing that things are fairly positive without being too positive now. Turning back up a little bit with this fear gauge, and we also tick down just a little bit here with this other fear gauge. So we're seeing a little bit of non-conformity here. We look at the risk on to risk off ratio. It did decline after we saw some profit taking in the large caps or the high beta stocks. We're starting to turn back up here with the volatility risk premium after getting to a very, very low reading. This going up might end up putting some pressure on stocks. The advanced decline line rolled over a bit based on price, but really didn't show an awful lot of weakness. It's still positive since it's above its moving average. We did decline a little bit more based on volume, but also still above its moving average. The negative divergence that I've been pointing out here is we broke out based on price. We have not broken out here based on volume. This is actually quite positive. That gap higher open up to R1 that we saw was enough to trigger a whole lot of new highs. This is actually showing strength in the S&P right now. This green keeps going up. So our 5-day and our 10-day are also going up, and we really didn't see any new lows being generated. After being extreme in the short term, the blue line is now dropped below here. That's the 19-day advanced decline ratio. We ticked down just a little bit with the 39-day, but we're still above zero, so this is positive. And after getting extreme with the advanced decline ratio here, this is the same chart, but just represented in a different way. We're coming back down, and we also dropped back down based on volume. This is the longer term positive one that I was referring to, where this takes a while for this to shift and move. We're coming back across the green line here, which is 90%, and that is the 10-day average of the S&P 500 highs minus the lows. This is suggesting good longer term, well, I should say more intermediate term momentum. And we did come down a bit here with accumulation distribution. We are turning down here, but we're above an advancing moving average. So this is still positive. The boom indicator, which tries to measure the distance from the indicator to the moving average, is rolling over and no longer extreme. The chicken money flow continues to be positive, and the red line is going up, so this hasn't changed yet. But here, we're starting to come back down with the chicken oscillator. Is this giving us a little early warning that things might turn more negative? Now, when we were really coming down here, and we had the big down day early August, this started to turn and go up before we really saw much happening based on price. So is it warning us now that things could get a little weaker? I don't want to base a whole, conclusion on just one chart. We just want to be aware of this. The vortex continues to go up and is looking positive. The green line's going up as the red line's going down. And we're breaking out here with the S&P 500 advanced decline line on base that we look at it on a cumulative basis based on price. That's still breaking out. We never did really break out yet based on volume. And both declined, but the red line and it's pretty much matched up right now with the S&P 500. This is the NYSE advanced decline line, which is on one scale compared to the S&P 500, which is on a different scale. Then we look at the cumulative advanced decline line for the NYSE. It did decline with the down day, but the regular NYSE advanced decline line, it ticked down, but it's really holding up well, as is this other NYSE advanced decline line. And then we break it out based on common stock. We came down a little bit, but still breaking out based on price. Came down, but just about a little bit of a breakout here based on volume. And we're still holding up okay with the advanced decline line across all the other different indexes that we follow, even though they all declined. And here's the short-term chart where we did fall down a little bit here. We're still above the 50-day moving average. And down at the bottom, you see where the red bar here, it's below average, but it's greater than what we've seen over the last few trading sessions. And the condition of the 20-period moving average trend is we're still looking good. Even with the decline, we have not come back down to the lines yet, so the lines continue to advance. Here's our 20-period simple and exponential moving averages. Decline, but still above both lines, so that continues to advance. We're no longer extreme with the boom indicator. We have become kind of far away from the 20-period moving average. Now it's starting to drop back down. And we're coming down a little bit with the 50 and the 200, but they were not extreme. And after being extreme with the 20-period exponential moving average of the S&P, this is just starting to drop back below 80. We declined a little bit with the 50 and the 200. We're still extreme positive, even though we dropped here with the Stochk RSI. We dropped with the Williams percent R, but it's still extreme. The CCI 14 is no longer extreme, and the CCI 20, it doesn't really look like it, but this is 100, and we came in at 98.08. So we're no longer extreme with this indicator. We're rolling over, but still extreme in the short and intermediate term. We still are going up with the long term, but now we're starting to get extreme positive here. And the force index did decline, but it's still positive. And we're right on the border between the +1 and +2 channel for our standard deviations chart. But everything is still going up. The midpoint's going up. All these ugly purple lines continue to go up as well. And we're no longer extreme with the balance of power. It dropped below this black line after it had become extreme positive. We're still just barely extreme positive with the CMB composite, but we haven't dropped below the line yet. Here's the condition of the 50-period moving average. We dropped, but the lines are still going up, and we're still above the lines. And here's our 50-day simple and exponential moving average, also continuing to go up for right now. Here's all the moving averages. Price is still above them, even with the decline that we saw on Thursday. The longer we can stay above this, the more all of these lines will continue to go up. And we're looking a little more neutral-ish right now with the go, no-go, with the light shade of blue here. And we did drop a little bit with the highest high value, but we're still above the midpoint, and the midpoint continues to advance. The TTM squeeze getting a little bit above this black line. As I always say, I put this black line on here. And then to give it a little bit more context, this is a longer term look at that same chart. And we could still go up more from where we're at, but we could also stop where we're at. I just look at all of this over a period of time and I go, okay, this looks like a good point. And then if I can line it up with a round number, that's where I decide to put the black line. So there's nothing magical about that. It's just used as a reference point. Standard deviation is starting to come down, but still quite high over the last 10 periods. We're still positive with the ease of movement, and the Erin indicator continues to be positive. The oscillator is above zero and actually advanced. And after being extreme, the S&P McClellan oscillator has now dropped below the 60 level, so we're no longer extreme, but we're still above zero. And when we're above zero, that means the summation index based on price is going up. We continue to go up based on volume. So these continue to confirm each other, even with the down day. We declined, but we're still above zero with the NYSE McClellan oscillator. So we're still going up with the summation index for the NYSE based on price and volume. We did drop off a little bit with the Swenlin trading oscillator based on price, but we're still above zero. We're no longer extreme positive here based on price. And the momentum still looks positive with the PMO, and then we break it out based on price and volume. They continue to be positive. We're no longer extreme with the PMOs that are rising. We're still going up with the buy signals, even though it's slowing down, and we're continuing to advance with the PMOs above zero. And we've gone from being positive to neutral now with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're still extreme, but positive here with the slope oscillator. The MACD continues to be positive. All of our oscillators on all the different time frames still continue to be positive. And another momentum oscillator, the Copic curve, continues to be positive. And we're no longer in the initial extreme area here with the Sean trend meter. It did decline. But we're still going up with the bullish percent index. That gap higher open that we saw may have produced some new point and figure buy signals. So this is still looking good and was actually up on a down day. And we're also looking good here with the NYSE bullish percent index, continuing to go up above 50. This is positive. We ticked down a little bit here with the NASDAQ 100. It was more the mega caps and semis, and that's going to hit the NASDAQ 100. So we did decline, but we're still above the 70 level, which is considered to be extreme positive. The money flow continues to go up and is above 50. That's positive. After getting extreme, we're coming down with the ultimate oscillator, but we're still above 50. And on-balance volume did decline, but we're still above an advancing moving average. And I tried to put in some areas here. When this is green, that means that we spend the majority of the time above 50. That shows good momentum. When we drop down below 50, that's red. That means that we're more negative. We haven't really been up here very long yet to put this in a green area. Even though we're coming down with the RSI, we're still above 50 with both the 14 and the 9 period. And we're no longer extreme here with those stocks inside the S&P above their 20-period moving averages. We dropped down slightly. So looking at our study here, we're still above this 70 level, which is suggesting that the short-term strength is still there. We ticked down a little bit, but we're still above 50 with those stocks above their 50-day moving average. We were flat with those stocks above their 100-period moving average. Declined, but still well above 50 with those stocks above their 200-day moving average. This is the mass index. Part 1 was when we went above the red dash line. Part 2 is when we went above the blue line. Now that we've come down, actually, you could say there's 4 parts because it has to cross back below the blue line, and now it's back down to the red dash line. This is when the official signal is triggered. You may want to stop and look at this and see what happened when other signals were triggered. Sometimes it was kind of a big deal. Other times it was a non-event, but we are getting a signal from this. Since the context of why this indicator was going up is that stocks were going up, this is suggesting that there is a potential reversal, which would mean stocks would begin to decline even more than they did on Thursday. And the Pring bottom fisher, though, it's still generating a bottom buy signal, even though we've been going up. Try to figure that out. Okay, and then we are coming into a new 50-day cycle. Maybe we won't only know this until we look back to know, oh, yeah, this new cycle that started on August 19th, yeah, I guess that ended up being something after all. And that's not good enough for me to look back and go, oh, yeah, I wish we would have done this then. That's not how my approach to technical analysis is. I like to use foresight instead of hindsight. Okay, looking at the Ichimoku cloud, even with the decline, we're still above the cloud. The blue line's still above the red line. That's positive. And the green line did decline, though we came down with the S&P. And we're still well above this R2 level here on the weekly chart of the S&P. So yeah, there was some give back, but we haven't really broken any longer term support, at least yet. We came close to this 61.8% fib extension level here. This could be providing some overhead resistance. We were pretty close to the all-time high, but we weren't quite able to get to that. We'll see if Friday is able to make that any more clear. And our different charts, we're still looking good with the Heiken Ashi chart. This is a positive trend. We're still positive with the Kagi chart, positive with the Renko chart, and positive with the 3-line break chart. So these trend charts have not changed. Long term, we did come down with the 150. We're right at the 350 level, so that's no longer considered extreme. We're still above the 350 level here with the 200-day moving average, just suggesting good long-term momentum at this time. We're still positive with the Keller market model across all the different indexes and time frames. No changes here either. Commodities are still negative across the board, as is the dollar. Still positive across the board with the decision point scorecard. And we saw a lot of nice green or blue right to start off today, but then things kind of turned a little bit more negative. We tried to bounce back up and then ended up being more negative as we closed out the day. And let's see, we saw real estate financial up the most, and with energy and healthcare being up fractionally, but all of the other sectors ended up being down, with tech getting hit pretty hard. And that probably suggests profit taking. And discretionary was also down as well. And we look at the S&P compared to the equal weight S&P. We declined with both, but the red line's still above the S&P. Yes, they're on different scales though. And we came down a little bit here with our ratio. That just means that the mega caps underperformed the rest of the S&P. We're still positive here with the new highs minus the new lows on the NYSE. And then this red line going through here is a 50-day moving average. Lately, I've been just focusing on the day in and day out score for this particular indicator. We dropped, but we're still above the pivot point here with the Dow. We've gone from being positive to neutral with the diamonds. And we came down to the 50-day moving average with the NASDAQ, and also down to the 50-day moving average with the NASDAQ 100. Is this going to provide support? If we break below that, is that going to cause more concern? And we've gone from positive to neutral with the QQQs, with the Elder's Impulse system. The momentum, though, for the NASDAQ 100, weakening a little bit, but it's still positive. And we're coming right down here to the 50-day moving average with the QQQs. So we're seeing this not only on the index, but also here in the ETF. And not really, kind of in between here, when we look at the Fib extensions chart, we never got up to the 38.2 extension, nor have we fallen to the 23.6, at least yet. The small caps were down here, kind of got to the high end of this more recent range. Now they've been under some pressure lately. And when we look at the Russell 2000 small caps, coming down a little bit here with the RSI, but still above 50, still above the 50-day moving average. The momentum continues to try to stay positive. And we're still positive here with the Elder's Impulse system for the small caps. And we look at the ratio between small caps and tech. We bounced up with this ratio because small caps held up better than the tech sector. And we drop back down below the pivot point here with the mid caps, but we're still above the 50-day moving average. And we've gone from being positive to neutral with the Elder's Impulse system for the mid caps. The Wilshire did decline, but is still above its 50-day moving average. The blue line's above the red line, so the longer-term trend continues to be positive. Same thing is true here with our other total U.S. stock ETF. We declined 0.84%, but still well above the 50-day moving average. And the Staples to tech ratio went up as Staples had a better day than tech. We want to see this going down to be more positive on the market. And this could be working itself out here, where we're seeing the correlation starting to get stronger again. When we look at the S&P on top and the home builders ETF in the middle area, it is continuing after they were diverging from each other. Now it looks like we're coming into more of a convergence. And we did drop below the 50-day moving average of the FANG index, so we'll have to keep an eye on that. This was the 200-day moving average when we had the big down day on August 5th. We were able to bounce up off of that. Are we going to see more weakness here, or are we going to be able to recapture the 50-day moving average? And I just drew some trend lines on here where when we were really going down, we dropped below this trend line, but we recouped that, and we broke above the shorter-term trend line. Now we're right back down to the trend line again. And we look at the financial sector, it was up 0.57%. It's looking solid, and this bodes well for the stock market when the financial sector is doing well. Apple was down 0.83%, but still above its 50-day moving average. Amazon was down over 2% and right between its 50 and 200-day moving averages. Over 2% with Microsoft. See, the big stocks, they kind of got hit a little bit here. We were down 1.25% with Google, and we were down 0.6% with Meta. Nvidia was down on 3.7%, but still above its 50-day moving average. So you take all these together, and that's why the S&P went down. And Tesla was down 5.67%. It dropped below its 50-day moving average. That's what was hurting the discretionary sector. Netflix was down 1.17%, but still well above its 50-day moving average. Then another broad market measure of the 5-period moving average of the highs minus the lows, we continue to be above zero. Oil continues to, well, it was up, but it's still continues to be in the low to mid 70s. We're waiting to see if this is going to really spike up if geopolitical events really escalate in the Middle East. And the dollar, after really declining, did tick back up. We're in danger of seeing a death cross here, but it hasn't quite happened yet. This is also showing a trend line here where we broke below that trend line. If we bounce back up, will this act as resistance, or will we be able to recapture this downward sloping trend line here? The international to US stocks here, short term strong, longer term getting stronger with the relationship between the two. And we were up with the 10-year yield. We were down with the 10-year based on price. And we're showing a little bit of weakness again here with the Qs to S&P. These are our different growth to value ratios coming back down to the moving average, back down to the moving average with discretionary to the S&P, back down to the moving average with large cap growth versus large cap value. So we're rolling over, but still above an advancing moving average with the large caps, coming back down to a flat moving average with the mid caps and dropping below the moving average with the small caps. And we're going back down just a little bit here. Not much of a change, but the S&P to utilities ratio, we want to see this going up for the S&P to be positive. If this continues to go down, that would be more negative for the S&P. And this had been coming back down here. The Staples to S&P ratio, well, it ticked up on Thursday. That's more defensive and not as positive for the S&P. So what's our outlook for Friday? It's going to be about Chair Powell and his Jackson Hole speech. The market will be tuning in. We did get a lot of retail sales earnings reports this week, and for the most part, they've been taken as positive, and that's been giving support to the market. The technicals are positive, but we're declining after being overbought on below average volume. And then we're going to get new home sales, which, yeah, it's kind of an interesting report, but not anything all that major. And then all the different geopolitical events going on and if they will even have an impact on the market. So we'll finish out the economic calendar for this week. Also with new home sales here on this other calendar, we'll see how those come out. And then we're neutral to positive across the board when we look at the Stock Traders Almanac. Now we are finishing up the week after options expiration, where we're up 65%, down 35%. And this looks pretty, well, it's kind of a coin toss here. We're just a slight positive slant here for August 23rd. And Friday is one of the more positive days of the week. And then this is another new chart. This is, okay, what have we been doing? Because this previous chart, this is based on what happened in 2023. This is what's been happening in 2024 to this point. And Thursday ends up being the best day. Well, not this Thursday, but all of the days end up being positive across the board, with Thursday being the best, then Friday, and then Monday. Now, if we go back to the other chart, Monday was the most positive day in 2023. Tuesday was a coin toss. Wednesday was negative. Thursday was okay, with Friday being the second best day. So just a little way to compare things. Not really anything to make decisions off of, but just kind of interesting. And then we do see a little bit of positive seasonality here with the Stock Traders Almanac before we see some negative choppiness going into the latter part of the month, which I think this is wrong because the Democratic Convention is taking place now. So I think this should have been back here. All right. And then comparing all election years with what has been happening in 2024. And then when there's an open field, which is what we have this time, there is some weakness going into the election. And then it's September. That's the month that can sometimes be very difficult for the market. This also confirms how September can quite often be negative. And this goes from 1929 up to the present time. When you take August and October together, not a real gangbuster time, going back to 1928. And then when you just look at August, though, usually an election year is the most positive, but look at how everything is negative for September. And just trying to match up 2023 with 2024. And this is getting a little bit outdated now, so we'll have to see if we start to match up a little closer again. So what are our warning signs? We're keeping an eye on these defensive sectors like staples, utilities, and healthcare, watching energy in case it bumps up due to geopolitical reasons. Growth and value, discretionary to staples, they're not leading right now. They're showing some improvement, but they didn't improve on Thursday, and they're not really taking a leadership role right now. The home builder study, it was diverging, but now it's starting to adjust and actually get more back in line with what the S&P 500 is doing. Positive signs still have a pretty long list. This should actually be changed over. The 5-day is now going up, where the 10-day continues to go down. I didn't change that. And we're looking at our smart money indicators. We're a little bit concerned here with the Chaikin oscillator. It's starting to roll over, and we'll have to use other charts to confirm that if something is actually happening. But when we take all three of these together, they continue to be positive. The advanced decline lines, we look at the S&P and NYSE McClellan oscillators and summation indexes. They're all positive. The Swenlin trading oscillator, and all these decline, but they're still positive. So the Swenlin trading oscillator is positive. The parabolic SAR are oscillators. The bullish percent indexes for the S&P, NASDAQ 100, and NYSE. The ease of movement, money flow, ultimate oscillator, Copic curve, and vortex. They're all positive, and the financial sector is looking pretty good. And the momentum for the NASDAQ 100 is still positive. So our conclusion, we're positive. We did see a decline on Thursday after we had become overbought, and the market is on below average volume. That made it somewhat vulnerable if selling was to really pick up, which is what happened on Thursday. In the short term, we're positive, but declining. Our list is becoming a bit shorter. We're also seeing a bit of a shorter list here in the intermediate term, but we're still positive. And we are still positive in the long term, even though our 200-day moving average is looking a little extreme there. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.